Welcome back. You're watching the Citizen Business Center, and in a moment I'll be speaking to the CEO of the Narobi Securities Exchange, Geoffrey Odundo, who'll be telling us more about what he reads into what we mentioned earlier. That's, of course, the central bank opting to retain its key lending rate unchanged at 11.5%, and what then that means for investment in 2016, as well as lending rates for those who have taken loans from the local banks. Now, lending rates will remain unchanged, at least for the next 6 months. This follows the central bank's decision to hold its policy lending rate unchanged for the 7th month running. CBK's first monetary policy committee has decided to retain the central bank rate at 11.5% and the Kenya Bank's reference rate at 9.87%. And as Bella Genga now tells us, analysts see this as a response to rising inflation, as well as a move to keep the Kenyan shilling stable.
Consumers can rest easy at least for the next 6 months following the Monetary Policy Committee's decision to keep the central bank rate and the Kenya Bank's reference rate unchanged for the 7th consecutive month. In its first meeting of the year, the CBK's Rate Setting Committee has held the central bank rate at 11.5% and the Kenya Bank's reference rate at 9.87%. This amid efforts to check inflation, which broke the CBK's target ceiling of 7.5% to hit 8% at the close of 2015. Financial analysts and economists had already foreseen the CBK leaving its signaling lending rates unchanged.
So by the second half of the year, we think if the currency markets are not selling off in a very big way, then that will allow the Central Bank of Kenya to think about reducing interest rates in the second half of the year.
However, interest rates are expected to rise gradually in the first quarter as the government steps up domestic borrowing to raise funds for ongoing rail, road and energy projects.
Most African countries who raised Eurobonds now would have to borrow money at about 10% or more in that market in US dollars. So I think it's much more likely that we're going to see local government borrowing continue.
But according to the CBK Governor, Dr. Patrick Njoroge, the market remains optimistic of faster economic growth this year. Most analysts have pegged Kenya's economic growth at between 5.8% and 6% this year on the back of ongoing infrastructure projects that are expected to improve the country's business environment in the long run. Bella Genga, Citizen Business Center.
Thank you very much, Bella, for that. And that, of course, forms the basis of our discussion tonight with Geoffrey Odundo, the CEO of the Narobi Securities Exchange. And the questions we are asking is there hope for borrowers this time round? What does it mean to the overall cost of living, which has, of course, been on a steady rise? And will the CBK's latest decision really count when making decisions this week? Just a bit of profile on Geoffrey Odundo. He's the CEO of the Narobi Securities Exchange, 22 years experience in investment banking. Previously, he was the CEO of Kingdom Securities. He's got a BSc Mathematics and Economics from Egerton University, as well as an MBA in Strategic Management from the United States International University here in Narobi. Thank you so much for joining us tonight. Of course, it was quite some tense moments there for people in the market waiting to see what CBK was going to move, and we've seen that they've decided to hold the rate as well as the KBRR. How do you read this move by the CBK?
The first thing I must say is that I think Kenyans have now learned to appreciate the importance of the CBR rate as a signaling parameter for how economic direction our economy has to take. And that alone just gives us a bit of confidence that it's becoming a more reliable instrument to be able to predict the economic performance and which direction we intend to move. Now, my reading of this particular retention of this rate is that there is a deliberate effort to provide or to strengthen the economy, to maintain the macros to where they should be at levels that can actually promote growth. If you give it, given the 11.5% was actually a rapid rise from the 10% in May last year, and it has been very stable going forward. This has basically addressed the inflation aspect. It's also addressed the issue of interest rates and the forex rate. So it has been a very, very important parameter. So I think retention of that rate signals that we're actually on a very good recovery. And as long as it can, and as long as our real sectors then support that, then I think we'll basically be seeing a real the objective of the 5.8 to 6% is a reality.
Would you say, there's some hope for borrowers now? And we've just watched the Razia kind of Standard Chartered Bank saying that perhaps in the second quarter or the second half of this year, Standard Chartered Bank will be able to reduce their lending rates. Do you see finally maybe investors coming down to either lower level double-digit or at least single-digit lending rates?
I'm pretty confident that will happen. If you look at what's happening globally, for instance, there's a very huge drop in the crude oil prices, and this has had a very serious knock-on effect on all, especially people who rely heavily on imports. Now, that's good for us because Kenya is insulated. We're not oil dependent. We're not an oil-producing country. So the import bill for our country is going to come down. What does that do? It then tends to spur reduce the cost of production, that spurs demand, makes the cost of goods and services more affordable, and hence we'll then see a strong performance in our very manufacturing sectors. Now back to your question about how will this affect credit. I think as long as the reference rate remains where it is and the CB and the KBRR rate, which is also a benchmark rate for lending instruments, as long as those remain stable, then banks will have to expand credit, and more so private credit. And the government itself is also trying to avoid crowding out potential borrowers in the private sector, and that's why they want to use external borrowing. They want to use other instruments, for instance the Kiba and the normal borrowing instruments, to just be able to also raise capital to finance their programs. So that lack of borrowing or crowding in the banking sector will then force banks to actually come in and lend to borrowers. So I do see a bit of competition in the near short term, especially banks trying to readjust the rates downwards to respond to consumer demands.
And some would argue, of course, that banks really do not pay attention to the KBRR and the central bank rate because they place the rates at whatever they wanted. Let's look at 2015, which was quite a tough year for the Narobi Securities Exchange. There was a price stumble for quite some number of stocks. I remember Local Daily, saying about 8 or 7 of some of Kenya's wealthiest people had lost an average of 17 billion in such a short span of time at the Securities Exchange. How has 2016 started off?
I'm very excited to say that we started 2016 on a very strong footing. I was looking at the numbers today, and our volumes year to date is about 434 billion in terms of turnover in just the last 18 days. Majority of this is foreign, which is a good sign that they've actually appreciated that our macros are strong. I must note that they do pay a lot of attention on the macro factors in our country. On the local retail and institutional, there've also been a good recovery. Note that this year there is no capital gains tax on trading securities at the exchange. So there's been a recovery. We foresee a very strong return of investors, especially the local investors, into the market, because one thing is that the effects that we had in the last quarter of last year, where interest rates actually rapidly rose, that is now going to be addressed, because I see, as long as the CBR rate and the central bank signals a lack of strong appetite for very aggressive rates, then we're going to see a recovery and people coming back into the market. So I can quite tell you the headlines are going to change dramatically this particular year. I hope they'll be able to blow them up equally as they were blowing up the downside to it. But we're pretty confident on what's going to happen, especially in the first 6 months.
All right. They say you do not congratulate a fish for swimming with the current. But we'll wait and see how that spans out. How long do you think it will take to recover, given your positive sentiment? And of course, given the fact that we are actually heading into an election year, we are already way into the campaigns.
I think this is a recovery year. I expect to see good recovery in the first 3 months, and that should be able to run throughout the year. One thing I must say is that we've tracked our performance of markets during election times, and the market is very insulated. to the political factors. I think people prize in the political risk, and as such, we never see a real knock-on effect. The last time we ever saw that was in the year 2000. But subsequent years, we've actually seen the market remain resilient, even during political time. So I think Kenya's or investors are going to focus more on the fundamentals. We expect to see double-digit performance of companies, especially the financial, insurance, and services sector. Tourism is recovering. Our agriculture sector is recovering. So that's what's going to drive demand in the market. I think the markets are going to remain very strong and very resilient to the political issues that are going to come in late in the year. One
would say you're being a little over-optimistic, given that, you know, we saw about 11 companies that were listed give profit warnings, and that would mean we either expect announcement of losses or cut down on profits. That means less dividends or no dividends at all. How will the market continue to remain attractive then?
I think this will be a recovery. Most of the companies last year who reported profit warnings had two key issues affecting the performance. One was the cost of financing operations. With a high interest rate environment, definitely, and most of them are leveraged. So they had to really get an impact on the cost of borrowing. Secondly, some of them had exposures to the equity markets, and of course they all price the equities to the markets. So when there's a devaluation in the equity markets, then they have to take that knock on the books. Now, as long as the market recovers, and that's why I'm saying I'm pretty confident to see a recovery this year, that performance will turn around. I do not anticipate this year that we will see that level of profit warnings coming through, given what we saw last year. So we're pretty confident about it.
All right. As we wind up, the SME segment of the Securities Exchange, that's the gem, seemed to not excite investors enough if the numbers that we've seen are anything to go with. Why do you think that did not pick up as expected, and what is the plan for the gem segment?
The GEM segment this year is a real focus for us. We are very, we've done our studies and tried to find out what the reasons are. One was lack of knowledge. We still need to do a bit more education to the potential issuers, a bit more incentives. We were able to give them an incentive because today if you list through introduction in the GEMS market, you get a 5% reduction on corporate tax. So there are a lot of other things that we've done to be able to encourage that. Now, what are we going to do different this year? This year we're going to have a very industry-led forum on various sectors. For instance, in the innovation sector, we are no longer just going to wait for companies that have actually been set up, but we're going to look for companies that are really setting up. We've got a very strong IT sector in our country, and try and bring all the players together with unique or very specific industry institutions so that it's very focused. And in that forum, we'll then have advisors, we'll have registrars, we'll have transaction, we'll have the issuers all coming together, thinking together, and hopefully actualize some deals from there.
All right, thank you so much. Geoffrey Odundo, the CEO of the Narobi Securities Exchange, sharing with us his thoughts this evening. Thank you very much for being on the Business Center tonight.